March 23, 2020. The S&P 500 had been falling for 5 weeks straight. Every support level from the previous 3 years had been destroyed. News headlines were competing to be more catastrophic. Global markets were in free fall. That day, the index fell to 2,092. Exactly the low from December 2018. The last significant equal low. The level where, for the previous 15 months, everyone who was long had placed their stop-loss order. Price hit that level, every stop fired, billions of dollars in forced sell orders hit the market in a single afternoon. Then price reversed. It never went back. What followed was the fastest recovery in stock market history. 11 months later, the S&P was at all-time highs, but by then, most of the people who had been invested had already sold at the bottom, stopped out on March 23rd. That is not a coincidence. That is a mechanism. History doesn't repeat itself, but it rhymes. Welcome to Hidden Patterns. Today we break down the specific mechanics of the trap that fires before virtually every significant market rally. Why it happens, where it happens, and what it looks like on a chart the moment before it reverses. To understand why the trap fires where it does, you first have to understand where retail traders actually place their stop losses. Most traders, whether they know it explicitly or not, place stops at the same places, not because they're copying each other, but because the same visual logic produces the same conclusions, equal lows. When price visits the same level twice without breaking below it, that level becomes a magnet for stop-loss orders. The logic is, if price goes below here, my analysis is wrong. I want to be out. The more times price touches a level without breaking it, the more stops accumulate below it. 2 equal lows is a clear signal. 3 is a neon sign. Round numbers: $50, $100, 10,000. Psychological thresholds where traders set alerts, entries, and stops. The round number at Zu Naran for Bitcoin in early 2021 had more stop orders clustered beneath it than any precise technical level ever could. Obvious support. The more obvious a support level looks on a chart, the more retail traders place their stops just below it. The obvious nature of a level is not reassuring. It means more stops are there, and therefore more reason for price to visit it. From the perspective of a large institutional order that needs to buy, these clusters are not obstacles. They are the solution. A buy order worth several $100 million cannot be filled quietly. It needs counterparties, sellers willing to sell at the current price. Stop losses, when triggered, become market sell orders. They create exactly the volume needed. This is where people hear manipulation and assume bad actors are deliberately targeting their stops. Sometimes that's true. In some markets, coordinated players do engineer these moves specifically, but the deeper reality doesn't even require it. The stop-loss clusters are real. The need for large orders to find selling volume is real. Even without coordination, the order book creates this pattern mechanically. The physics of markets are unavoidable. The trap fires because it must, not because someone decided it would. Here is what the trap looks like in real time, on any chart, at any time frame. Step 1. Identify the liquidity pool. Look for equal lows, 2 or more wicks or closes at the same level. Look for obvious support that has been tested multiple times. Look for a round number just below current price. These are the locations where stop-loss orders cluster. In SMC terminology, sell-side liquidity. Step 2. Watch for the approach. When price moves toward the liquidity pool with momentum, especially after a period of consolidation above it, Pay attention. The move toward the level often looks like a breakdown. Bearish momentum, increasing fear, news reasons to explain why price is falling. All of this is part of the trap. Step 3. The candle that fires. The trap fires as a specific candle pattern. Price breaks below the established low, volume spikes, the stop orders are triggering, creating the selling volume needed to fill a large buy position. Then, within the same candle, or within 1 to 3 subsequent candles, price closes back above the level it broke. The anatomy: a long lower wick reaching into the liquidity pool and a body that closes back above. The wick is the trap. The close above is the tell that it has been sprung. Step 4. The reversal confirmation. If the trap has fired, subsequent price action becomes distinctly one-directional. Pullbacks are shallow. Each wave higher extends further than the previous one. The selling pressure that drove price into the trap has been absorbed. There are no sellers left. They were all stopped out. In June 2022, Bitcoin had formed a double bottom at 600 during the May collapse. That level accumulated stop-loss orders for 3 weeks. On June 18th, price broke below $600 to $500, $100 below the equal lows. Volume spiked. Then price closed the day at $700, back above the level with a long, lower wick. 4 months later, Bitcoin was at 600. The people who had their stops at 600 were out. The people who recognized the trap were in. The cluster, the approach, the candle, the close. 4 steps that describe a pattern visible in every market, every time frame, going back as far as charts exist. Subscribe to Hidden Patterns. The next section covers why this pattern appears across every asset class and the mirror image that fires at tops. The liquidity grab appears in every market that has large institutional participants and retail traders with stop losses, which is every market. Forex, major currency pairs at round numbers, create some of the largest liquidity pools in financial markets. USD JPY at 150 ZUZO, EUR USD at 1,000, GBP USD at 1,2000. These levels generate institutional scale stop hunt events. The Bank of Japan spent years trying to defend 150 ZA on USD JPY, precisely because the round number created a clustering of speculative positions that amplified every move. Equities. In individual stocks, the liquidity grab often appears as a shakeout before earnings-driven rallies. Price drops below the low of the recent range in the session before an announcement, stops fire, retail sells, then reverses on the news. The traders who held or bought the grab capture the move. The traders who had stops at the obvious level are out before it starts. The sell-side equivalent: everything we've discussed applies in reverse at market tops. Price runs above obvious resistance, above equal highs, above round numbers. Buy-stop orders trigger, becoming market buy orders. Large sellers use that buying volume to fill large short positions. Price reverses back below the level. This is the buy-side liquidity grab, or liquidity sweep, and it appears at every significant top for the same mechanical reason. The fractal nature of this pattern is what makes it so useful. The same setup, the same anatomy, the same entry logic applies on a 5-minute chart and a monthly chart. The scale changes. The structure doesn't. The next time you watch your stop-loss trigger and then see price immediately reverse, without reaching any further target, without any news reason, without any change in the fundamental picture, you were not wrong about the direction. You were right about the direction. You were positioned in the location where the trap had to fire. This reframe changes everything. The trap doesn't disprove your analysis, it confirms it. The institutional buyer needed your stop to complete a position in the same direction you were trying to trade. You provided the liquidity. They took the trade. Learning to recognize the trap, the equal lows, the approach, the wick, the close above, doesn't require predicting the future. It requires reading the mechanics of what already happened and asking, is this a breakdown or is this a grab? That distinction, applied consistently, is the difference between being the counterparty and being the trade. The pattern has a mirror image at market tops, the buy-side liquidity grab above obvious resistance. We cover that in the shorts linked below. And the full three-phase structure, accumulation, manipulation, distribution, is broken down in the video above. Subscribe to Hidden Patterns. The market doesn't move against you. It moves through you, toward the liquidity it needs. Hidden Patterns, subscribe, and we'll see you in